So thank you very much for having us. This is joint work with Igor Makarov, who is also on Zoom. This paper is called Blockchain Analysis of the Bitcoin Market. And what I want to show you are a number of new facts about this very interesting new market. And obviously the motivation in this conference is somewhat unnecessary, but you all know that cryptocurrencies and of course a number of different coins have grown very significantly over the last decade. And there is now more and more debate, exactly in venues like today, to think about how the integration of these new technological advances would fit into our existing financial infrastructure, and how we should think about the benefits and the challenges that are embedded in these new technologies. And so what in this paper we want to do, focusing on Bitcoin, because it still is actually the largest coin, we want to dig deeper into describing the infrastructure and the different important players within this financial infrastructure, so that we can have a much more informed debate about, the opportunities and also the challenges. So, kind of with this, this is, kind of a really, baby reminder of, in a way, what we are trying to show here, what we are looking at, right, is that, of course, in a traditional financial infrastructure, the key nodes are financial institutions through which a lot of, or all the transactions run, and through which different counterparties transact. And the promise and premise of this new trust architecture is, of course, to, if you want, almost invert the financial infrastructure and not have centralized nodes that are prone to potential failures and potential corruption, but basically have this distributed ledger that works through the fact that we have many different nodes, validators or miners, that are ensuring the validity and the integrity of the blockchain. And so then in each different node here, we would have a copy of the ledger that, as long as the majority of validators are not corrupted, would then ensure the integrity of the blockchain. But of course, this new financial infrastructure and this whole architecture depends on a set of new entities that are now key in, kind of in the blockchain ecosystem. In particular, right, we need to understand how exactly these validators, and in Bitcoin, they're called miners, obviously, how these miners function, how their concentration looks like, given how important it is that they stay non-corrupted, and also that obviously not 51% have a majority of ownership, of mining capacity. And then, of course, we also want to understand how integrated and connected the network itself is. And so this is basically where our paper now, kind of comes in. So in this paper, what I will show you is a systematic analysis of the Bitcoin market using the Bitcoin blockchain data. And in particular, we have a lot of different results, but I want to focus on three main ones. I will show you some results about the network structure itself, basically looking at how the major nodes, which in particular are the exchanges right now, how they are interconnected, and how transactions across these nodes actually look like right now, how they can be traced, or kind of what cannot be traced. And then I also will show you how important exchanges currently are. They are constituting about 75% of volume, and they are also kind of very interlinked, which will become clear in a second. The second piece I want to show you is the ownership concentration of the major holders or hodlers on the Bitcoin blockchain. in particular, we document that ownership is very concentrated. And here it is very important, to differentiate between ownership by individual holders versus, say, intermediaries that are holding on behalf of others. And so what I will show you is that concentration among the top 1,000 investors, ownership concentration actually means that about 1,000 investors control 3 million BTC, and the top 10,000 investors control more than 5 million BTC. And then finally, I'll show you some results about the concentration of miners and also their composition and regional distribution. So we study the concentration of miners, again, using blockchain data and tracing miners from the mining pool, coin rewards, down to the individual miners. And just as a preview, we show that there's high concentration about miners. About 50 miners often control about 50% of the total hashing power in the market, but this varies also with the price of Bitcoin. All right, with this summary, let me kind of now get into the actual results and what we call data here, right? So obviously you're all aware of the fact that Bitcoin transactions are available and publicly accessible, if you want, on the blockchain, but they are anonymous or pseudonymous, because it is typically not possible to know exactly who stands behind a given address, right? And so obviously Bitcoins are stored in these addresses, and then on the blockchain, Bitcoin transaction record how Bitcoins move between different addresses. And this is just here to give you an example of how a digital footprint would look like, right? In this transaction, money is sent from one from one address, right, to several different addresses. But also, right, the change is then being sent back to the original address, because, kind of in a way, this is how transactions are being recorded on the blockchain. And so we have two main challenges with, if you want this type of data. First, of course, is that given that for every transaction, theoretically, an individual holder could actually set up a new address when, say, sending back these Bitcoins even to themselves, the change of the transaction, right? And in many apps and many exchanges even encourage participants to use actually lots of addresses because they are freely available. So the first challenge with this then means that we need to tie Bitcoin addresses to an entity or to a wallet. And for this, we use clustering algorithms that have been developed before in the computer science literature, and we are using very conservative ones so that we are not mistakenly clustering addresses together that do not belong together. This is actually, kind of detail in a lot of detail in the paper. If you want to take a look, I will spare you this in the talk today. Now, the second challenge is, of course, to link these anonymous addresses or even the wallets to real life entities, so that we can actually have a sense of, say, how important are exchanges, OTC brokers, or kind of other participants on the blockchain. So how do we do this? So we obtain the data using open software from Bitcoin Core and also the BlockSci program to convert these raw addresses into a database. The data for this talk today is as of June 28, 2021, and we have about 650 million Bitcoin addresses and 850 million unique, 650 million transactions and 850 million unique addresses. And then we link those addresses to real life entities using public and proprietary sources. So we scraped lots of different crypto blogs, websites such as Reddit, Matt Bia, and many others. And then we also work with a state-of-the-art database provider, Bitfury Crystal Blockchain, that is tracking entities on the blockchain for anti-money laundering purposes in particular. And so with this, right, putting all this together, what we then have is what we think is actually the most complete data source about crypto entities that has been used in academic research. We cover more than 1,000 of the largest entities, in particular, as you see, almost 400 exchanges, many gambling sites, online wallets, payment processors, etc. Yeah, so, kind of that's, if you want the data. So let me now show you, as I said, the results for some of the largest participants and the most important pieces of the Bitcoin infrastructure or ecosystem. So the first is, let's look at ownership of Bitcoin and how it has evolved. Why is this important, right? First, it's important to understand how concentrated the ownership looks like, because it will affect who stands to gain from any price appreciation in crypto, in particular in Bitcoin. Is it, the wider public or a select fewer entities? And that's, of course, in particular important, given that the hope and the premise for this new financial infrastructure was to democratize and decentralize the beneficiaries from financial intermediation, kind of in a way to provide something different from maybe what the more traditional financial system might be perceived of doing, right? And then, of course, why the concentration of ownership is also very important to understand is that, as say we have shown and other people have shown previously, is that given that there is still a lot of impact that large holders can have if ownership is very concentrated, we do want to know how this looks like. Now, why is this a challenging task? You might say, I know that there's something called the rich list of Bitcoin, and that has been tracking the richest and the largest balances for a long time. But of course, the large address doesn't by itself mean that it's a concentrated owner, because we have now more and more intermediaries, like say Coinbase, Binance, etc. So exchanges, OTC brokers, and others that are holding Bitcoin on behalf of potentially many, many investors. And therefore, a large address is not immediately a concentrated one. So therefore, it's very important to differentiate holdings based on behalf of intermediaries, through intermediaries on behalf of many people, versus the holdings of individual entities. And so what we do here is we use graph analysis and we examine the utilization patterns of these addresses to separate intermediary and individual accounts. And then, of course, for, say, intermediaries where we know the address of their cold wallet, we can also just assign, right, that this is, say, Binance cold wallet or, kind of Coinbase hot wallet, etc. So again, right, the details are in the paper, but once you do this, we can now split out the ownership of intermediaries versus individual holders. And so let me first show you the intermediary ownership pattern. So here you see kind of basically from the beginning of 2010 until the middle of 2021, not surprisingly, the number of Bitcoins that are held in the wallets of intermediaries has grown significantly. And in particular, right, starting in 2014, when, maybe there was even more exchanges came online, you see this actually growing quite a bit. And so as of the end of 2020, we find that exchanges and other intermediaries hold about 5.5 million BTC in aggregate. And again, right, this is not a sign of concentration at all. This could be many, many individuals that kind of that these intermediaries hold Bitcoin for. But of course, some of these addresses, kind of can also hold BTC for, say, the, kind of some of the largest owners of large exchanges. Yeah. And then just as a, as an aside, this is basically a time period when about 18 million BTC were in circulation. And then, kind of maybe more interestingly, if you want, if we now switch to the individual ownership, you actually see a number of interesting things. So, we see that if you look, kind of at the graph on the right, this is BTC ownership as of December 2020. And you see that about 8.5 million BTC are held by individual owners. So, right, this is millions of BTC, and this is basically giving you the ownership concentration. But you also see, kind of from this distribution, that there is very high concentration. So the top 1,000 investors control about 3 million BTC, and the top 10,000 control about 5 million BTC. Now, right, what is important, or you might think, in the back of your mind, are a lot of these actually maybe very early adopters that have since either kind of lost their password, or kind of basically don't have ownership of their accounts anymore. And that is not the case. We actually we traced back when were the last time that an address engaged, and had an active transaction, and you actually see that even once you rule out any addresses that have not been touched, if you want, since the beginning, we still actually see, kind of almost the same high ownership concentration. So, kind of this is basically, the first fact that I want to show you, which is that maybe different from the narrative of kind of the more idealized version of BTC, the owner, at least the concentration of participants, is not is still very concentrated, right? Now, let me show you now the second piece of information about how mining infrastructure and the mining ecosystem looks. Now here, right, what's important to understand and where our contribution comes from is that we are able, for the first time, to trace Bitcoin rewards to individual miners, not just to mining pools. So, we have public information, and there has obviously been a lot of attention on mining pools. And, kind of, I'm just giving you, a breakdown of the largest mining pools, again, as of the middle of 2021. As I'm sure many of you know, mining is done in pools because these pools are, if you want, loose combination of miners that co-insure each other by pooling capacity in a mining pool. And these mining pools are very concentrated. We also know that a lot of the pools are registered in only a few places, including China, Kazakhstan, and so on. But what a large literature has now started to point out, of course, is that mining pools are not miners, right? So, for example, Kong and co-authors, or also Daniel Ferreira, have worked on this issue and have pointed out that really the power of mining pools depends on the size distribution of the miners underlying these pools, and also of the ease of switching between pools, right? So if miners are very concentrated themselves and can easily switch between pools, even the concentration of pools wouldn't tell us very much, right? Because the power might actually lie with the miners. This is why it is important to identify how concentrated the mining capacity in the hands of miners are. So what we do is we identify miners by tracing pool distributions, so coin-based rewards, down to the miners. And we are basically looking at about 250,000 miners that we can identify working for these different, the largest 20 pools. So what do we find? So here we see that there is actually significant concentration of mining capacity at the miner level. And let me, there's a level effect, and then there's actually an effect over time, because we find that the concentration varies with the Bitcoin price. So let me explain to you what these graphs are. So if you focus, say, in particular on the right hand side, what we are plotting here for you is, over time, say since 2015 until again the middle of 2021, you see that, say, the blue line here plots the number of miners that control 50% of mining capacity. And then the red line, right, shows you the number of miners needed to control 40% of mining capacity, and so on. And so, focus, say, on the blue line here. What this tells us, right, is that there have been time periods where about 50 or even a bit fewer than 50 miners, right, controlled 50% of mining capacity. And then, kind of say, if you look at the red line here, right, that's the 40% capacity line. What you see is actually there have been periods for fewer than 25 miners controlled 40% of mining capacity. So in terms of level, right, this is actually quite high concentration, because remember, given the clustering algorithms that we use to trace also the miner wallets, right, this is always a lower bound on concentration, because we are being conservative not to cluster any wallets together where we are not 100% sure that they belong together, right? And so any user who might not want to show all the coins that they are holding could actually be holding even several of these mining addresses, right? Now, the second thing that is actually interesting from this, that comes out of this analysis that's interesting, is that you see that mining capacity varies significantly with the price of Bitcoin. And in particular, right, so this is the log BTC to USD price, the dotted line here, right? But what you see is in time periods when the Bitcoin price slumps, mining capacity, the concentration of mining capacity goes up. Which is worrisome, right? Because it basically means that the likelihood of a potential 51% attack could co-vary with the price and with price drops in BTC. The other thing that we find is that actually our data and this approach that we're using also allows us to identify where miners are located. And while I don't have time to show you the details today, right, what we do is we look, for example, at this famous or infamous event in Xinjiang province where there was a mining accident, and here, I mean, a real coal mining accident that took electricity off the grid for several days because the Chinese government, or the local government shut down coal mines because several miners were trapped, and then many were ultimately killed in this event. But because of this shock to the availability of electricity, we are able to actually trace miners who are losing access to power during this time period, which allows us to then identify miners that are, and now I mean BTC miners, right, that are physically located in this province in China. And we also show actually that the structure and composition of where these miners cash out their BTC is a good proxy for where these miners are located. And so what we find, if you want, with this, kind of proof of potential approach, right, that 70% of miners at that time in the middle of 2021 were located in China based on our analysis. Now, of course, since then, the Chinese government has, kind of clamped down more on miners in China. And so some of that mining capacity seems to have actually relocated to other places. In particular, right, people, kind of a lot of industry participants say that capacity has gone to places like Kazakhstan, now maybe even Indonesia, Malaysia, and the Philippines. But, kind of, the truth is there are also lots of reports that the clampdown across provinces in China has been very uneven because not all local governments want to actually lose all that economic activity. But maybe most importantly, right, what we need to understand is that just because that capacity doesn't maybe all sit in China anymore, right, it might still be as concentrated as before because, these miners might have just changed the physical location of the mining capacity, but might still be, as concentrated as before. So, kind of, this is just to show you that this type of data and this type of analysis gives us a lot of opportunities to drill much deeper into what's really going on in the infrastructure, and basically in the behavior of some of the most important participants, if you want, in this ecosystem. All right, so the last piece I want to show you is now, how does the network structure of the Bitcoin ecosystem look? So, kind of what we do in the paper, and again, I don't have enough time to show you all the details, but what we are able to do, of course, is that we can trace transactions across these different participants on the blockchain. And we show that about 75% of blockchain volume is for trading activity. And it's important to understand, right? This is on-chain volume. This is not off-chain volume for centralized exchanges where, a lot of wash trading can happen, a lot of fake trades, as people, many people have already attested or claimed, right? This is actually on-chain volume that we're tracking. And we basically see that a lot of this volume from and to exchanges is either individuals trading and sending money to exchanges or receiving it, but also a lot of trade, a lot of volume between the wallets of exchanges, which might be a sign of arbitrage activity that is going on, right, where Bitcoin are being sent between different exchanges to take advantage of price deviations between them. We also show that other transactions, in particular, say for gambling or illegal transactions, are only a small fraction of the share of total volume, about 3% combined. So I want to say two things to this, right? And again, I urge you to look at the paper for the details. This volume is much less than, kind of many previous studies have found. The reason is that we go through a lot of length in our paper to differentiate spurious volume and pass-through volume from true economic activities. That's actually really important because all this spurious volume, so addresses are being set up to just pass volume through, either to hide it or maybe because your wallet protocol wants you to, kind of do a lot of set up new addresses, maybe even for security purposes. Those type of transactions obviously are not real volume, and they would double count activities that are not real activities. So, kind of that's why in this paper, we strip out all this type of double counting. And then what we find is that the share of these illegal transactions are much smaller. Now, let me also say that doesn't mean that they are not important, right? It's still a real concern if this type of activity goes through the blockchain. But why it's important to understand the true magnitudes, of course, is that it will affect how we think about what explains the valuation of BTC, right? And that basically the expectation of high amounts of illegal transactions cannot be the driver of BTC volume, kind of given these type of numbers. And then the other thing that we show in our paper is that exchanges are central and entities on the blockchain and are highly interconnected. Just, to give you a sense of this, so this is a graph of the largest nodes on the BTC network. And what you can see basically is of the 25 largest nodes, 18 are known exchanges, so places like Coinbase, Binance, Bitfinex, right, all the names that you know. 3 are online wallet providers, and 2 are, of these largest nodes on the blockchain are unknown entities, so that we couldn't name, but where we can see from the transaction flow that they're likely large OTC desks. And the other thing that you see, right, is that this is almost a complete graph. All the nodes are interconnected with each other. And there are also, what's interesting to note here is that even entities that are sitting in very different geographies, very different jurisdictions, right, are very interconnected. And in particular also, right, nodes that say have been imposing stricter KYC norms, like say Coinbase or Gemini, are very connected with nodes that are, at least until recently, have not done much enforcement of KYC norms, know your customer information. So let me show you as a last piece that I want to share with you, why this is actually important when we think about the integration of these type of cryptocurrencies into the financial, the wider financial system, right, is that this interconnectedness obviously provides opportunities, but it also provides many challenges. And in particular, it provides challenges in tracing and differentiating tainted Bitcoin from, if you want, white or legal ones. So just to give you an example of the challenges, kind of that the network will face and is facing, here's an example where we look at a known illegal marketplace. So this is Hydra Marketplace, which is the largest darknet trading marketplace on the web. You can buy and sell all the unpleasant things you can imagine, from drugs and guns to people and so on. What we have is basically we have known addresses that are, so if you look at this graph here, addresses that we know are connected to Hydra Marketplace, and then we are tracing where do Bitcoin that are either flowing out of Hydra Market or into Hydra Market, what nodes are they connecting with? And what's interesting is 2 things. First, you can see that a lot of the flows from and to Hydra Market go to large exchanges that are not doing KYC enforcement. So for example, Bitslato, local Bitcoin, but also Binance, right? So the size of the ball is basically the number, the volume that goes through these nodes and the strength of the connection. So you might say, oh, that's not surprising, because if they don't do KYC enforcement, then of course these Bitcoins can land there. We also find that the direct connection, say, of Hydra addresses to exchanges that do better KYC enforcement, such as say Gemini or Coinbase, are, kind of those direct links are much weaker, right? So much fewer Bitcoin are basically being able to be sent from a wallet that is, kind of say a trader on Hydra into these exchanges. And you could say, oh, isn't, kind of this is good news on face value. It looks like good news, right? Because those type of tainted Bitcoins do not flow into, say, Coinbase or Gemini. But unfortunately, the story is not as positive as this, because what we do find is actually that while the direct links between Hydra and, say, Coinbase or Gemini, are weak, we do find, however, that there are lots of Bitcoins that flow from Hydra into these type of pass-through or mixing clusters. So these are the turquoise nodes here that you're seeing in the circumference, right? And what happens here is that Bitcoins are sent into these type of nodes, and then are actually sent even to Gemini and Binance, and Coinbase. And so a lot of tainted Bitcoins actually ultimately do end up on exchanges that are doing KYC norm enforcement, because, right, they are able, whoever is the owner of these type of Bitcoins is able to send them into these type of mixing nodes, and therefore then hide the true owner or the true emissary, if you want, where these Bitcoin come from. And so let me end, kind of basically on one, kind of implication for KYC.
So you have 2 more minutes.
Exactly, I'll be done exactly in 2 minutes. So, for KYC regulation, and so what I want to, discuss now is, what do these results actually mean when we think about the integration of these new technologies into the financial system, right? In our current situation, KYC entities are allowed to accept flows from entities that have very lax or even no KYC norms. And as I showed you, that then means that it's very easy for tainted flows to come back into what we would be hoping is a more, regulated or wide network that shouldn't have so many tainted flows. And so then, right, even if these KYC entities were restricted to deal exclusively only with other KYC entities, preventing inflows of tainted funds would now require placing severe restrictions on who can transact with whom, or we would have to be willing to have third parties doing the verification of these flows, which then ultimately, right, gets us back into a system that actually traces a lot of the flows and puts a lot of, if you want, emphasis or power on the hand of these either companies or entities that would be approving transactions. And obviously, right, because everything is then on the blockchain, it will actually have severe implications for privacy, because now you don't even have, say, the veil of a bank that we normally have that protects an individual's information from being, kind of seen by everyone on the blockchain. So this is, kind of one of, in my mind, one of the really large challenges that this new infrastructure will have to face and will have to grapple with, kind of how can we balance the need and the wish for privacy with also the wish of preventing unwanted and unsavory entities like terrorists, illegal traders, rogue governance, as we have seen, in our unfortunate current geopolitical environment, from using a infrastructure that is ultimately decentralized and anonymous, as cryptocurrencies are. And, kind of there are obviously a lot of technology companies trying to address some of these challenges, but kind of those to me are some core regulatory issues that we all will have to grapple with. And so, to be in time, so the main takeaway here is from this work is that the majority of Bitcoin volume as of right now is for trading activity on the blockchain, and the exchanges are currently, and remember these are what we are tracing right now are mainly centralized exchanges, are central entities on the blockchain. The Bitcoin ownership is very concentrated, and so is actually the mining capacity, which kind of should make us think about how close the promise and the narrative of these new technologies is to the reality on the ground. All right, thank you very much.